Hi, this is Brian Vendig, President and Chief Investment Officer here at MJP Wealth Advisors. I thought it'd be a great time to check in with all of you since there's been a lot of current events. We want to provide some updates regarding how things are going with earnings season, some policy decisions, and our outlook over the balance of the year. First thing that I'll just start with is it seems like the bullish narratives that are out there are outweighing some of the bearish narratives, and we would still continue to be positive about stocks and bonds in your portfolio over the balance of the year. We're still seeing strong consumption from the consumer in 2026 and also through the end of 25. Now, granted, there has been some decrease in spending due to price, but year over year spending is still north of 2%, which is a great indicator. We also have policy measures that are helping to support the economy as well as businesses and the consumer. We're seeing the potential for deregulation across the financial industry over the course of 26, which would support M&A activity and loan growth, which is good. We also have the Fed looking to be less restrictive in 2026 with the potential of one or two more rate cuts, we think, in the second half of the year. And the big tax bill that was passed on July 4th, the big beautiful bill, is also providing tax incentives to spend on R&D research and CapEx, as well as we're seeing quite a big difference in refunds coming back to the consumer so far this year. We've had strong corporate earnings for Q4. We're expecting growth in earnings this year in 2026, as I've talked about before with you, of about 15%. And lastly, we've heard from the hyperscalers and some of the bigger names that they're continuing to spend on CapEx. Now, keep in mind, part of the reason why those numbers are much above analyst estimates year over year is because of the increasing cost of memory chips as part of that spending. But at the end of the day, it's still spending nonetheless. And next week of February 23rd, we hear from NVIDIA, which I think will be a great indicator to get a sense of the next wave of AI. Plus, we're waiting on hearing about OpenAI concluding a capital raise in February, which I think will also be a good indicator of where investor sentiment is for that AI innovation trade. Now, obviously, there's risks that are out there, whether it's fatigue coming from the consumer, not seeing productivity growth through AI, tariff and immigration policies impacting the economy and the labor market, policy mistakes, and also the timing of fiscal measures helping the economy moving the first half of the year and fading as we get into 26 and 27. These are all things that we're watching. But I think, bigger picture, most recently when we talk about policy measures is we heard from Trump on trade recently. And I think it's, worth noting that, about, the majority of the tariffs that were impacted by the Supreme Court ruling, mentioning that those tariffs were illegal. Trump has really supplemented that with a global tariff now up to 15% following Section 122 of the 1974 Trade Act. So it's worth noting that within that Trade Act, the president can institute a temporary import surcharge. He first announced 10%. He moved it up to 15% because that's what it actually says in the 1974 law. And we know that these tariffs can only last for 150 days, after which Congress needs to take action to extend them. However, I will note that the law is unclear whether or not the administration could restart the tariffs immediately after the 150 days. So a lot of these things, such as that timeline, plus what's going to happen with the tariffs fees that were collected and how could those be refunded or not. This is all going to be a legal issue that we know is still open-ended because the Supreme Court really didn't provide clarity there. I think the biggest thing moving forward is that there's still going to be other tariffs that are coming under this 301 investigation rule. China is currently in that and has been evaluated. So I think, all in all, the 15% global tariff that we've heard about recently really keeps things on par for our major trading partners. I mean, that's the rate that European trading partners on average were at. Other parts of Asia, ex-China, were around 15%. Canada, Mexico are being held out right now because of the ongoing negotiation there with the North American trade deal. I think what's going to happen there is we're probably going to see the US making its own individual deals with Mexico and Canada, respectively. So trade and tariffs is still going to be something we're going to hear about. But I think at the end of the day, what you have to look at is where this makes sense from an investing point of view. And I think when we look at the portfolios right now, we still see that the US, we're still leaning more towards the US than we are internationally, because the return on equity, the ROE, the money that you make on an investment, is still the highest in the US. And last year we did increase exposure to international from a developed point of view. So that means increasing exposure to Japan and different parts of Europe. But I think this year, when we think about policy, it's more of looking at where do you think the dollar is going to go and where are the profits going to come from. And we're looking at those profit forecasts, and those profit forecasts look pretty good for the U.S. and in different parts internationally actually look pretty robust. And so when we look at those profit forecasts and thinking about things going forward, we saw that profit growth has really started to occur significantly in emerging markets, or EM, versus other parts of the world. And we kind of think that because the U.S. is still running a deficit, because of some of these policy measures coming out of Washington, and also some policy measures coming out of the Fed, that you could get some dollar weakness over the balance of the year. So one change that you're going to see us making in the portfolio over the next couple of weeks is probably taking up international equities a little bit in our strategies and adding a small allocation in more of our growth-oriented portfolios to emerging markets. For clients that are a little bit more conservative, we're not going to be adding emerging markets because it is a little bit more of a volatile investment. But we think this makes sense for those that are looking for appreciation when considering about earnings growth, highlighted by the light blue bar, as well as a weaker dollar. So that's something worth noting. The other thing that's worth noting is that we don't foresee a recession still over the next 12 months because corporate profits have been a leading indicator. If you focus on the chart here to the right, with profit growth being what it is, 15% or more year over year, more growth coming from areas outside of mega cap tech, but mega cap tech still being the main sector that's leading to the S&P 500 profit growth year over year. We're not seeing profits going down, which usually is an indicator, a leading indicator for a recession that's around the corner. Plus, we've never seen a recession in the United States when the Fed is easing on interest rates, which is also something that we're expecting over the balance of the year. So that's why we're still being very constructive on staying long with equities, and also recognizing that there's volatility that's going to happen not only in the equity market and interest rates. It makes sense to stay with high quality bonds, shorter duration to reduce volatility from rates, and that's exactly where we are in your portfolios. And again, that consumer is being supported with this year-over-year increase in federal tax refunds, which I think helps in the first half of the year. It's really more where are we going to be in the second half of the year when you think about consumer spending and price. We still know that roughly half of the overall spending in the U.S. is coming from high-income earners. But you can really see across the data that people are sensitive to price across the board now, no matter what income bracket you're in. We're watching delinquency rates go up in some areas of the consumer spending economy, in auto loans and credit card and student loans and mortgages, something to keep an eye on. But all in all, we're still seeing a labor market that's bending, not breaking, not seeing mass layoffs. And within the labor market, we are seeing improved productivity because of the spending that's going into capital equipment, machinery, and goods, as well as AI. And also the fact that sales that are being generated from companies outside of tech from their employee base has actually been exceeding, and that's a good indication, as well as productivity. So if productivity measures continue to move in this direction, it helps to keep wage inflation down. It also helps to support economic growth. But we are seeing on an overall basis a decline in non-farm payrolls from where we were in the past, but we have seen recently a recovery. So this is something where, again, I think that labor market is going to be fickle to some things that are going on in the overall environment. And that's why I think the Fed is focusing more on growth, more on the labor market than it is on inflation. When you kind of take a look at outlooks for inflation, from the fixed income market and even some of the Fed's inflation measures. Lastly, I think the point I'll just make on sentiment regarding spending is the sentiment for the consumer has been more to the negative than the positive. And that's really because you can see in the chart on the right that inflation has been above what people make. And I think as a result, most people feel a little bit more stretched. And you're starting to see that across various income brackets as well. And you also can see some of the pressures that are impacting inflation are more negative, more inflationary than they are disinflationary. And I think the only way we're going to get to that 2% Fed target the Fed has held out there now for the last several years is if we move into a recession. And again, that's not something that we're looking at. So we're looking at inflation that's going to be at probably 3%, slightly less over the balance of the year. But the overall fixed income market is trading at 4% or more in most gauges. And I think that's the wiggle room that the Fed has, that 1% to cut rates one or two times to be a little bit closer to where inflation has moved to. Lastly, I'll just mention before we go, we've heard a lot about geopolitical events, whether it's in Eastern Europe or Iran, specifically, most recently Iran. We heard a little bit about geopolitical last month with Greenland, which fortunately has moved on. But I think with the buildup of a force in the Middle East, it says that it's pretty likely that there will probably be some conflict over the next couple of weeks or so with the U.S. and Iran, unless we hear from Iran that they want to get back to the table and negotiate in looking at moving past nuclear arms capabilities and other type of economic items that I'm sure Iran wants to negotiate with the West. But in the interim, if there is a conflict that breaks out, I have a feeling we'll probably get the question of how that would impact portfolios. I think we'd get a further distortion of price in the market between certain commodity prices going up, like oil and gold, due to the risk and uncertainty there. More of a sell-off in more areas of the economy that are more cyclical or growth-oriented, and a flight to being a little bit more defensive, for the first couple of days of this conflict. But when you look at history with other conflicts that have happened going back to 1939, you can see out, 6, 12 months, after the conflict, you start to see double-digit returns from the market. And I think because of the backdrop that we have with positive earning growth and some of those other macro reasons I mentioned before, we look at any dip in the market due to conflict as a buying opportunity. And also one that I would say it doesn't make sense to try to time the market and hedge, worrying about whether or not this conflict's going to happen. Because if you look out enough into the future, returns are still quite robust. So we're going to keep with our broadly diversified allocations that we have right now, even though we know that there's a conflict that's pending on the horizon. High quality bonds in your portfolio, broadly diversified large, medium, and small stocks with a little bit more, we think, of a tilt of adding a little bit more to international over the next week or two. One last thing I'll mention before we go is that we have seen some pretty big distortions in return in the market between value stocks performing better than growth stocks, international performing better than domestic stocks, small performing better than large. And this has all happened in a very, very short period of time. And it's not surprising when you look back at history, because sometimes we've seen this happen before, especially in midterm election years. But I think the level and the speed of these things kind of playing out is worth noting. Academically is similar to other times in the past where there's been major change and adjustments in valuation. And I don't think this means that you shouldn't be invested in the S&P 500, which is roughly flat on a year-to-date basis. But I think what that means is that as the year goes on and we get clarity on the AI innovation trends, we get clarity on policy decisions, I think there's a pretty good probability that over the course of the year, some of these things will start to revert back to the mean. But I think what we've done recently over the last month or two is we started to lean the portfolio a little bit more to value because of market sentiment, earnings growth outlooks for areas outside of tech. But at the same point in time, we're still holding true with our S&P 500 position, holding true with our U.S. large cap growth position. But we recently added to medium and smaller companies because of the expectation of lower interest rate environment. And again, as I mentioned before, adding a little bit more to international due to dollar weakness. So these are some of the areas that we're focusing on over the next couple of weeks as more data comes out. But I thought this would be a great opportunity to give you this update. Wish you all well. Thank you very much for your trust and support. And if you have any questions, please reach out to your primary advisor to schedule an appointment and talk more about your portfolio with some of these overarching themes in mind. So thanks so much, and looking forward to providing an update to you in the near future. Take care. Bye-bye.